Tokenized assets are changing finance. Imagine digital versions of real-world things. Stocks, bonds, even art can become tokens. These tokens live on a secure digital ledger. This technology is called blockchain. It offers new ways to own and trade assets. The journey began with a simple idea. That idea was to create a stable digital currency. This was a crucial first step. It aimed to solve a big problem in crypto. Cryptocurrencies like Bitcoin are known for big price swings. This volatility makes them risky. It makes them hard to use for everyday payments. People needed a digital currency with a stable value, something they could trust not to crash overnight. This led to the birth of stablecoins. These are digital currencies pegged to real-world assets. Most often they are pegged to currencies like the US dollar. They act as a bridge between old money and new digital money. One of the very first attempts was BitUSD. It appeared on the BitShares blockchain. This was back in 2014. BitUSD aimed to be a cryptocurrency worth $1. It was an ambitious project for its time. It used other cryptocurrencies as collateral. This collateral was meant to keep its value steady. BitUSD was a pioneer in this new field. It showed that creating a crypto dollar was possible. It laid important groundwork. However, these early stablecoins faced hurdles. BitUSD, for instance, had its share of struggles. Maintaining its peg to the dollar was not always easy. It sometimes faced liquidity issues. This meant it could be hard to buy or sell. The system was also quite complex for average users. Despite these challenges, BitUSD provided valuable lessons. It taught the market what worked, and importantly, what did not. These lessons paved the way for future innovations. Then came Tether, also known as USDT. It launched around the same time as BitUSD, but Tether took a different, simpler approach. It claimed to be backed one-to-one by actual US dollars. These dollars were held in bank reserves. This model was easier for people to understand. It helped Tether gain trust and popularity quickly. USDT soon became a dominant force in the crypto world. Many traders started using it daily. Tether's impact on the cryptocurrency market was enormous. It became the most widely used stablecoin. Most crypto exchanges listed trading pairs with USDT. This made buying and selling other cryptocurrencies much easier. It brought much-needed liquidity to the markets. USDT acted like digital cash for traders. It allowed them to move in and out of positions. They could do so without converting back to traditional money. This streamlined the entire trading process significantly. The world of tokenization soon looked beyond just currencies. The next big idea was security tokens. These are digital tokens that represent ownership in real-world assets, like company shares or real estate. This concept is often called real-world asset tokenization, or RWA. It promised to make illiquid assets tradable. It could open up new investment opportunities for many. This was a major step forward. It broadened the scope of what blockchain could do. A landmark example of RWA tokenization was the St. Regis Aspen Resort. This luxury hotel in Colorado tokenized a part of its ownership. This happened in 2018. Investors could buy digital tokens representing a stake in the resort. It was a groundbreaking moment for the industry. It demonstrated that high-value, complex assets could indeed be tokenized. The Aspen experiment captured attention. It showed the tangible potential of bringing real-world assets onto the blockchain. Many saw this as a glimpse of the future. The early 2020s marked a significant turning point. Tokenization started to attract serious attention. Major financial institutions began to explore its potential. Big banks and investment firms started pilot programs. They researched how blockchain could improve their operations. Tokenization was no longer just a crypto niche idea, it was rapidly moving towards the mainstream. This period saw a surge in development and adoption. The technology was maturing. Why did these established giants get interested? They saw several compelling benefits. Tokenization promised greater efficiency in financial processes. Transactions could be settled much faster, often in minutes instead of days. Costs could be reduced by cutting out intermediaries. Blockchain also offered enhanced transparency. Every transaction could be recorded on an immutable ledger. This made auditing easier and reduced fraud risk. These advantages were too big to ignore for long. A key milestone during this period was the tokenization of US Treasuries. These are traditionally seen as very safe investments. Bringing them onto the blockchain was a big deal. It meant that these secure government bonds could be traded as digital tokens. This could increase their accessibility to a wider range of investors. It also signaled growing confidence in the technology. If treasuries could be tokenized, many other assets could follow. This was a strong validation for the entire space. Stablecoin innovation also continued to accelerate. New types of stablecoins emerged. Some were backed by different currencies or commodities. Others used algorithms to maintain their peg. Their use cases expanded far beyond just crypto trading. People started using stablecoins for international payments. They became crucial components in decentralized finance, DeFi applications. Stablecoins were evolving into fundamental building blocks for a new digital financial system. The pace of change was truly remarkable. So what does the future hold for tokenized assets? Experts are overwhelmingly optimistic. They predict massive growth in the coming years. The technology is constantly improving. It is becoming more scalable, secure, and user-friendly. As regulatory frameworks become clearer, adoption is expected to spread even wider. We are likely just scratching the surface of what is possible. The next decade could see a profound transformation, a transformation driven by tokenization. The real-world asset or RWA sector is particularly poised for explosive growth. Some market analysts project its value could reach trillions of dollars by 2033. Imagine tokenized real estate, art, private equity, and commodities. Virtually any asset with value could potentially be represented on a blockchain. This would unlock immense liquidity. It would create entirely new markets. The scale of this potential shift is hard to overstate. It could redefine asset ownership globally. The benefits of widespread tokenization could be far-reaching. For asset owners, it can mean increased liquidity. Selling a fraction of a building becomes easier. For investors, it opens doors to fractional ownership. You could own a small piece of a valuable painting. Transactions could become cheaper and faster. Transparency would be enhanced, with clearer records of ownership. This could reduce disputes and fraud. These are powerful advantages for everyone involved in finance. Ultimately, tokenization has the potential to fundamentally reshape global finance. It could make financial markets more open and accessible. It could democratize access to investments previously available only to the wealthy. It could create a more efficient and transparent financial system. While challenges remain, the direction seems clear. The future of finance looks increasingly digital, and tokenized assets are set to play a starring role in that future. The journey that began with simple stablecoins is leading to a new era,